Welcome to the Deep Dive, where we cut through the noise to get you well informed on the most compelling topics in Web3.
Glad to be here.
Today, we're plunging into a truly fascinating challenge right at the heart of the blockchain world. It's current fragmentation. I mean, imagine trying to text a friend who has a different phone brand, but your phone just can't send messages to theirs. It seems basic, right?
Yeah, and that's essentially where many blockchains are today. They're powerful, absolutely groundbreaking in some ways, but often quite isolated.
It's a vast and exciting digital frontier.
Yeah.
But you're right. It feels more like a collection of digital islands than, a unified continent.
And that fundamental lack of connection is precisely what we're here to unpack today.
Exactly. So our deep dive is all about Axelar, or AXL. It's a project aiming to bridge these digital islands, essentially building what some have called the Internet of Blockchains.
A pretty ambitious goal.
It is. And our mission here is to give you a shortcut to understanding this complex yet really crucial piece of Web3 infrastructure. Look at how Axelar actually proposes to connect these disparate blockchain ecosystems.
We'll also dig into the role its native token, AXL, plays in all this.
Definitely. And we'll navigate a really interesting range of price predictions and market sentiments. We've got data from CoinCodex, CoinLore, the original Axelar whitepaper, its tokenomics laid out by Figment.
And even an investor's personal take, right, from Lee the Captain on YouTube.
That's the one. So quite a mix of perspectives to explore.
Okay, so let's start with the core problem itself. Why don't blockchains just talk to each other easily?
Right. The Axelar whitepaper really highlights this. You have major platforms, Ethereum, Monero, Cardano, Cosmos, Avalanche, Polkadot. The list goes on. They all offer unique features, different strengths.
But their ability to communicate across chains is described as very sparse and fragmented. That's the key phrase.
Which means, practically, that useful features, applications, even valuable assets often get stuck within one single chain's ecosystem.
Right, confined to just a tiny fraction of potential users. It limits everything.
It really brings us back to that iPhone to Samsung analogy, doesn't it?
It does.
And as Lee the Captain points out, this lack of interoperability, as he calls it, means even the giants like Bitcoin and Ethereum can't just freely send data and value back and forth without these complex, often clunky workarounds.
It's a huge barrier for what's supposed to be this seamlessly interconnected digital world.
Yeah, and it's not like people haven't tried to fix this, right? There have been attempts.
Oh, absolutely.
Yeah.
But existing solutions, they all come with pretty significant limitations.
Like what? What have people tried?
Well, take centralized exchanges, for instance. They let you swap assets between chains, sure, and they scale pretty well.
Okay.
But they force you to compromise on the core principles of Web3, decentralization, security, transparency. You're trusting a central entity.
Right, so not really a fit for building truly decentralized applications.
Exactly. They can't power that future vision.
So if centralized exchanges aren't the answer, what about those interoperability hubs? Things like Cosmos, Polkadot, Avalanche.
Yeah, the white paper touches on those. They're great for connecting side chains native to their ecosystems.
Meaning chains built within their own specific framework.
Pretty much. Like, a Cosmos zone generally has to use Tendermint consensus. They connect chains that already speak a similar language, if you will.
Okay.
But they don't inherently connect out to other major blockchain ecosystems that use completely different tech or consensus methods. They're good inside their own walled garden, essentially.
Gotcha. And then they're the direct bridges, right? Like wrapped assets, TVTC, and things like that.
Yes, pairwise bridges. They work, but the white paper notes they require substantial engineering efforts to build for each chain pair.
So not very scalable.
Not at all. And if one chain in the pair upgrades its software.
Oh, I see. You have to upgrade the bridge too.
Exactly. All the smart contracts involved might need complex changes. Plus, you create this messy web of dependencies. Just because you have a bridge from A to B and one from B to C
doesn't mean A can talk to C easily.
Yeah.
You'd need another bridge or some complicated logic on top.
Precisely. It's like building, I don't know, individual walking paths between every single house in a city instead of a proper road network. It just doesn't scale efficiently.
Okay, so that paints a clear picture of the problem. Fragmentation is like this big knot in the middle of Web3. How does Axelar actually propose to cut through it?
Well, Axelar's stated goal is ambitious, to be a uniform, universal solution, one that connects any blockchain, doesn't matter what its underlying tech is, offering truly frictionless communication.
Frictionless, that's the key word.
They want to bridge those digital islands into a cohesive, connected continent
So let's get into the solution itself. How does Axelar act as this plumbing for cross-chain communication?
It's designed as a decentralized network, first and foremost. Then it has protocols, tools, APIs, a whole toolkit, really. It's built as a platform for developers and a global community.
And you mentioned protocols. Are there specific ones we should know about?
Yes, two key ones. First is the Cross-Chain Gateway Protocol, or CGP.
CGP.
The white paper calls this analogous to Border Gateway Protocol on the internet.
Ah, BGP, the internet's routing system.
Exactly. Think of CGP as the sort of GPS for blockchains. It tells data packets how to get from, say, Ethereum to Avalanche or wherever. It's the routing layer.
And the important part is that blockchains do not need to speak any custom language or make big changes to plug in.
That's the idea. It's meant to be plug and play for the chains themselves.
Okay, so CGP is the routing. What's the second protocol?
That's the Cross-Chain Transfer Protocol, or CTP. This sits on top of CGP.
It's a TP on top of CGP.
Right. And this is the application level protocol, again, analogous to things like file transfer or hypertext transfer protocols on the internet, like FTP or HTTP.
So this is where developers actually do things across chains.
Precisely. CTP allows dApp developers to make cross-chain requests, things like locking assets on one chain, unlocking them on another, transferring them, or even triggering actions between dApps on different chains.
Ah, so that enables what they call composability of programs across the whole landscape.
Yeah.
Building apps that use features from multiple chains.
Exactly. That's the goal.
Now, who powers this whole system? You said it's a decentralized network.
It is. It's powered by a network of validators. These validators are chosen using a delegated proof-of-stake model, DPoS, which is similar to how Cosmos Hub works.
DPS, okay. And what do these validators do?
They collectively run a Byzantine consensus protocol. This is crucial because it means the network can securely agree on the state of cross-chain transactions, even if some validators are offline or malicious.
So building that trust layer between separate blockchains.
Absolutely fundamental. And what's really innovative is how the network acts as a decentralized cross-chain read-write oracle.
A read-write oracle. How does that work?
Okay, so for reading data from other chains, creating incoming bridges, the validators run light client software of those other chains.
Light clients, meaning they don't need the whole blockchain history, just enough to verify.
Correct. It's efficient. They verify the state of other chains and report it to the Axelar blockchain.
Okay, that's the read part. What about write? Sending things out to other chains.
For those outgoing bridges, the validators collectively maintain what are called threshold signature accounts on the other blockchains.
Threshold signatures, like needing multiple keys to open a vault.
Exactly like that. No single validator or even a small group can initiate a transfer out. It requires a collective agreement. The threshold is often set high, like 80% approval.
That sounds pretty secure.
Security is definitely a major focus. Axelar aims for maximum safety, citing that high 90% threshold needed for validators to potentially collude and steal funds or forge proofs.
And they have backups too, right?
They do. They mention robust fallback mechanisms, including an emergency unlock key and a maximally decentralized secondary recovery set if the main network somehow stalls. Extra layers of protection.
So what's the real-world impact of all this tech? For builders, for users like you and me?
Well, for blockchain platform builders, the promise is they can easily plug in their blockchains with minimal fuss, extending their reach significantly.
Makes sense. More connectivity.
For dApp builders, they can host their apps anywhere on whatever chain makes sense for them, but still leverage global liquidity and communicate with other dApps on other chains using that CTP API we talked about.
So breaking down those walled gardens for developers too.
Right. And for you, the end user, the goal is that you can interact with applications across any chain directly from your wallet, ideally without even noticing the complex cross-chain stuff happening behind the scenes.
Just a seamless experience.
That's the vision.
But is this vision becoming reality? Is Axelar just theory, or is it actually being used?
Oh, it's definitely being used. Lee the Captain, in his analysis, really emphasizes the real-world adoption. He states it's currently over 60 blockchains connected.
60? Wow. Any big names?
Yeah, includes major ones like Avalanche, Moonbeam, Cosmos, BNB Chain, Base, which is Coinbase's layer 2, remember Arbitrum, and Ethereum itself.
So connecting the major players.
And it's not just connected, it's handling volume.
Yeah.
He says it has facilitated billions upon billions of dollars worth of transfers and processed over 1 million transactions.
Billions. Okay, that's significant traction.
And Lee, the captain, also points to key partnerships as further validation. He mentions partners like Onyx by JP Morgan.
JP Morgan's blockchain unit.
That's the one, plus Microsoft and MasterCard.
Those are heavy hitters.
His argument is that these large traditional organizations do extensive due diligence before partnering. So securing those partnerships speaks volumes about Axelar's technology, its security, and its potential for integration.
Right, it's a strong signal of trust from established players.
Exactly.
Okay, so we've got a handle on the tech, the problem it solves, and the fact that it's gaining real traction. Let's switch gears a bit and talk about the fuel for this engine, the AXL token.
Right, the native token. It serves 3 primary functions, according to the documentation.
What's the first one?
Fees. Simple enough. AXL tokens are used to pay fees to the validators and the stakers for every cross-chain transaction processed by the network.
So every time data or value moves across chains via Axelar, someone pays a fee in AXL.
Essentially, yes. Although, interestingly, users don't always need to hold AXL themselves. The system is designed so that various services can accept gas, like ETH or AVX, on the source chain.
And then convert it behind the scenes.
Exactly. Converted to pay the Axelar network fee in AXL. Those collected fees then flow back to reward the validators and stakers who are securing the network.
Okay, fees make sense. What's the second function?
Incentives. AXL is used to incentivize securing the network through staking.
So rewards for validators and delegators.
Correct. Validators get compensated for producing blocks and validating transactions. And delegators, people who stake their AXL with a validator, also earn rewards for contributing their stake.
And Figment's analysis highlights this is key for network longevity and decentralization, right?
Yeah.
Encouraging participation.
Absolutely. It aligns everyone's interests with the health and security of the network.
And the third function.
Governance. Holding and staking AXL gives you voting power, weighted by your stake.
So the community gets a say in the network's future.
Yes. They can participate in decisions like which new blockchains or assets to add support for, or even potentially proposing changes to the network's parameters or fee structures.
Okay, fees, incentives, governance. Makes sense. What about the tokenomics? How many AXLs are there and who got them initially?
Figment provides a good breakdown. The total supply at Genesis when the network launched was 1 billion AXL tokens.
1 billion. And the distribution?
It was roughly 29.5% for the core company that includes employees, advisors, operational treasury, future hires. Another 29.54% went to the backers, the early investors.
Okay, so about 60% combined for the team and backers.
Roughly, yes. Then there was 5% for a community sale, like a public sale. And the largest chunk, 35.96%, was allocated for community programs.
Community programs. What does that entail?
Things like grants for developers building on Axelar, user rewards programs, and importantly, it includes at least 5% specifically earmarked for an insurance fund.
An insurance fund? For what?
Presumably to cover potential losses in case of, say, a major bug or an exploit, although the specifics might evolve with governance. It shows a focus on ecosystem health and user protection.
That's interesting. So a significant portion set aside for growing the community and ecosystem.
Yes, clearly a priority.
Now, you mentioned rewards earlier. Is the supply fixed at 1 billion or does it increase?
It's designed to be inflationary, at least initially, to bootstrap the network and reward those early participants. The supply gradually increases.
How does that inflation work?
There's a base inflation rate set at 8%. This gets split between rewarding validators for the Tendermint consensus part and for the multi-party signing protocols, those threshold signatures we talked about.
Okay, 8% base.
On top of that, there's an external chain inflation rate. This is an additional reward granted for each new blockchain network that Axelar connects.
Oh, so connecting more chains increases rewards.
Temporarily, yes. It's set at 1% extra inflation per chain in the first year, then it drops to 0.75% in year 2 and 0.5% in year 3.
Why does it decrease like that?
The idea, according to Figment, is to provide strong incentives early on to connect many chains, but then gradually decrease this specific inflation as transaction fees from actual network usage are expected to rise and take over as the primary reward mechanism.
Makes sense. Bootstrap with inflation, sustain with fees.
And this whole inflation schedule is subject to governance changes. The community can vote to adjust it later.
Right. Now, here's a really interesting point from Figment. The potential for the token to become deflationary. How could that happen?
Yeah, this is quite neat. If the total network fees collected from transactions end up being higher than the actual cost of processing those transactions and paying the base rewards.
So if usage is really high and efficient.
Exactly. Then the excess fees might turn deflationary through a token burn mechanism.
Meaning they'd use the extra fees to buy AXL tokens on the market and destroy them, remove them from circulation.
That's the concept. Buying back and burning tokens would reduce the total supply over time, potentially increasing the value of the remaining tokens, especially if network utility remains high.
That's a powerful long-term mechanism if the network gets enough adoption.
It definitely aligns long-term value with network usage.
One more thing on tokenomics. Were all these tokens available immediately at launch?
No, only a portion was liquid. Figment notes that locked tokens couldn't be spent or transferred initially.
But they could be staked.
Yes, crucially, they could be staked right away. This helps secure the network from day one, even with vesting schedules in place.
And how did the vesting work?
Community sale participants got about 5 months worth of their tokens unlocked at Genesis. The core team and the backers started receiving theirs 3 months later, with longer vesting periods spread out over time.
Aiming for long-term alignment, preventing early dumps.
That's the standard rationale, yes.
Okay, so we've covered the tech, the problem, the token. Now for the part everyone always asks about, the price. Let's try and unravel the AXL price puzzle. What are the forecasts saying?
Well, brace yourself, because this is where things get interesting and often contradictory.
I expect as much in crypto. First, where does it stand right now? Or, well, as of our data snapshot, August 9th, 2025.
Right, around 36 USD per AXL token, 36 cents.
Okay, 36 cents. Now the short-term outlook.
Yeah.
What are the different sources predicting for the next few weeks or months?
This is where we see a stark contrast. CoinCodex, which relies heavily on algorithms analyzing past price action and technical indicators.
Yes, what do they see?
They predict a significant drop. They forecast the price to drop by negative 24.83% and reach 0.272223 by September 8, 2025. That's just a month out.
Wow, down to 27 cents. That's quite bearish.
Very. They even suggest that for the rest of 2025, the potential ROI compared to current rates is negative, and advise investors could profit from negative activity by shorting AXL.
Shorting AXL.
Yeah.
Okay, that's one perspective. What about CoinLore?
CoinLore paints a much, much rosier short-term picture.
How rosy.
They predict AXL could reach 0.361 turn in the next 10 days, basically holding its current level. But then looking out for the rest of 2025, they forecast $2 or one.
$2.01 compared to 36 cents now?
Yep, representing a 450.3% increase from the current price. They attribute this to a high likelihood of a bull market for AXL in 2025.
Okay, so CoinCodex sees a drop to 27 cents, CoinLore sees a rise to $2. How do we even square that circle?
It really highlights the different methodologies, doesn't it? CoinCodex seems focused on technicals suggesting a correction, while CoinLore might be factoring in broader market optimism or Axelar's adoption fundamentals more heavily.
And then we have the investor take, Lee the captain. Where does he fall in this short-term picture?
He's firmly in the bull camp, highly optimistic. He explicitly states he's still buying and continues to dollar cost average in AXL.
So he's accumulating despite the current price. What's his target?
He believes AXL could hypothetically go to the price of $25.
$25?
Yes. And get this, he thinks it could happen around 6 to 10 months from right now, so still within that 2025 timeframe, or maybe early 2026, depending on when right now it was for him.
That would be, let me see, from $36 to $25. That's way more than a 30x gain, isn't it? Closer to 70x?
Yeah, my mistake on the 30x earlier. It's much higher based on the current price. He mentions around a 30x from here in his video. Perhaps the price was higher when he recorded it, but based on $36, it's a massive jump.
How does he justify such a huge leap so quickly?
He compares potential market caps. At $25 per AXL, assuming the circulating supply doesn't explode, the market cap might be around, say, $25 billion. He compares this to the past all-time highs of meme coins like Shiba Inu, 40Bs, and Dogecoin, $80, and even a major exchange token like BNB, $100.
So his argument is, if those assets reach those valuations, why can't a fundamental infrastructure project like Axelar?
Essentially, yes. He sees AXL as being in a sweet spot. It's not a tiny microcap, so maybe not too overly risky, but it's also not a dinosaur either, like Bitcoin or Ethereum, where you wouldn't realistically expect that kind of explosive gain in such a short period.
It's definitely a high conviction bet based on perceived potential versus established giants and, well, meme coins.
A very high conviction bet.
Okay, so the short term is a battlefield of opinions. What about the longer term? Say, looking out to 2030 or beyond? Do the sources agree more there?
The general trend across sources becomes more bullish long-term, but the peaks and timelines still differ quite a bit.
Let's start with CoinCodex again. What's their long view?
They forecast prices potentially reaching 1.512978 by 2030.
Okay, $1.51 by 2030. That's a 313.46% gain from today's value, according to them. Still significant growth, but much more conservative than the $25 target.
Right. And their algorithm's highest projected price, looking way out, is $9.67 by 2050.
$9.67 by 2050. Okay. Now, CoinLore's long-term view, are they still more bullish?
Oh, yeah. CoinLore predicts AXL could reach $4.86 USD by 2030.
486. That's more than triple CoinCodex's 2030 target.
It is. They note that's 13.32 times from current price and is 2.09 times higher than its all-time high, which is around $2.32.
And even further out.
CoinLore gets really optimistic. They forecast $17.35 by 2040.
$17.
And even $25.16 by 2041.
25.16 by 2041. So CoinLore eventually reaches Lee, the captain's $25 target, just about 15, 16 years later than he predicted.
Exactly. It's fascinating how different models arrive at similar numbers, but on vastly different timescales.
It really underscores the uncertainty. What about general market mood? Any indicators on sentiment?
We get some clues. CoinCodex notes the Fear and Greed Index is at 67.
Which indicates greed in the market.
Correct. Suggesting investors are generally feeling positive, perhaps a bit overly optimistic, market-wide.
But for AXL specifically.
CoinCodex's technical indicators show neutral sentiment overall, 19 indicators flashing bullish signals versus 9 bearish ones, so kind of mixed.
And CoinLore.
CoinLore indicates a more bullish short-term sentiment based on their indicators. 7 suggest buy versus 6 suggesting sell. Still pretty balanced, leaning slightly positive.
What about the RSI, the Relative Strength Index?
Both sources put it in the neutral zone. CoinCodex has it at 49.37, CoinLore at 34.19. Neither suggests it's extremely overbought or oversold right now.
And moving averages, those usually give trend signals.
Mixed signals there too, depending on the time frame. You might see shorter-term averages suggesting BUY, while longer-term ones are still signaling sell, or vice versa. It paints a picture of uncertainty in the current trend.
So, beyond the charts and algorithms, what other factors do these sources say actually influence the price?
They mention the fundamentals, of course. Supply and demand for the AXL token itself. Key events like Bitcoin halvings, which tend to lift the whole market.
Right.
Protocol updates from Axelar, new features, major partnerships announced, regulatory news, good or bad, always has an impact.
Sure.
And broader adoption by companies or governments using Axelar's tech. Plus, they always mention the activity of whales, those large holders. Because the crypto market is still relatively small compared to traditional finance, big moves by whales can significantly swing prices.
Okay, that makes sense. Lots of moving parts influencing the price beyond just the project's tech.
Definitely.
And we absolutely have to say none of this has been investment advice. Cryptocurrencies are incredibly volatile.
Highly volatile. And past performance, or these forecasts, certainly don't guarantee future results. Please do your own research.
Absolutely. This is purely an exploration of the information and sentiment out there, trying to understand the different ways people are analyzing Axelar's potential future.
So maybe let's try and tie this all together. If we recap Axelar's core vision.
Yeah, it's really positioning itself as this critical foundational piece of the Web3 puzzle, isn't it?
It is. Offering a comprehensive solution to that fundamental problem of blockchain interoperability. Trying to build a world where apps and assets can just flow seamlessly between chains.
Like websites talking across the internet, enabling that true composability.
We've seen how it uses its tech, the CGP and CTP protocols, that decentralized validator network to aim for plug-and-play connectivity.
Empowering builders, simplifying things for users. That's the goal.
And we've definitely wrestled with the price predictions, from those cautious short-term algorithmic forecasts to the extremely ambitious targets from investors and some long-term models.
It really shows how different analyses and market sentiment can paint wildly different pictures, doesn't it?
It absolutely does.
So maybe the final thought to leave our listeners with.
Yeah.
As Axelar works on weaving together this fragmented Web3 fabric, what truly new possibilities might open up when blockchains can genuinely speak the same language? What does that unlock?
Yeah, how might that reshape the digital world we're building? Could it lead to entirely new kinds of applications or, new business models, new forms of digital ownership that we can barely even conceive of right now?
Something to definitely mull over. Keep those questions in mind.
And we hope these insights spur you to continue your own exploration into this fascinating and rapidly evolving space.
Thanks for diving deep with us today.